All right, welcome to the mid-semester review. So again, this session is completely optional, but it's good that you guys showed up. As you all know, we do have a mid-semester exam on Thursday. I don't think anybody forgot that. Just to recap, it will be held here. It will be 90 minutes long, plus a 10-minute perusal. Again, you'll get a Word document, a spreadsheet with some numbers, and you'll also get the formula sheet. Now, the formula sheet is up on iLearn, and even this whole review session, the slides, you can find exactly where you can find the formula sheet. So if you go into assessment, and then you go into examinations, then you'll get all the info relating to the midterm. So again, you have the previous midterm from the previous semester, the formula sheet, the solutions for all the homework questions, and the review slides for this session. So again, I think it's pretty straightforward in terms of, I guess, what we're going to be doing today, and that is essentially just reviewing the past 5 weeks worth of material. Now, obviously, I can't include everything, but I'm basically trying to highlight all the important parts that we've covered so far. Before we do that, does anybody have any questions about anything relating to the midterm that's not related to the content? No? Sweet. All right, so before we start talking about the actual content, I want to rehash how to answer a question effectively on any kind of given exam situation. So when you have the, I guess, the luxury of doing an exam on the computer, it's super easy to start doing outlines. So I highly recommend that when you try to answer a question, outline it before answering it. Even if I guess think about it from the perspective of you might run out of time, the best thing you can do is at the beginning, just outline all your answers. Because if you run out of time, I have an outline I can mark, even though you haven't actually explained stuff, you have something there. And again, there is like diminishing return in the sense that the more effort you put into a question, the less of a return you generally get. So to get to a pass is very quick, to get to a credit a lot longer time, get to distinction much longer, and then high distinction much longer. So getting to a pass level on all questions is very, very quick if you know the content. And that is also why, again, outlining really helps, because basically it helps you to make sure that you've covered everything, because again, if you want to get a good grade or a higher grade, you want to be, I guess, thorough in your answer. You want to show that you've essentially kind of more or less understood the entire content. And to do that, you really need to outline your answer. Also, whenever we've discussed, again, this says theories or frameworks, but basically whenever you can, try to refer things that we would have learned in this class. So for example, when talking about forecasting, we learned about the issue of mean reversion. So this would be considered a theory or some kind of underlying rule that we can kind of follow. So whenever you can, try to refer to some of these things, because again, just shows a higher degree of understanding. And then also kind of related to the idea of outlining an answer, giving bullet points without explanations or anything is not great. So if you want a higher grade, use your bullet points to kind of focus your writing, but when you do that, explain the concepts that you've actually listed in the bullet points. And when possible, just use an example just to show that you can kind of explain this and how this would actually apply in practice. And then finally, long answers don't necessarily mean good answers. So long answers generally do mean that you might know a bit more, but it sometimes might actually mean the complete opposite. So I've had, I guess, instances in the past when the student would have gotten probably a distinction had they stopped writing after the first paragraph. Then they added a second paragraph, which kind of showed me that they don't really know what they're talking about, so I kind of docked them down to a credit. So again, long answers are only good if you know what you're talking about. So don't write for the sake of writing, write if you have something that's kind of relevant to say. And again, that's a bit like fluffy in terms of direction, but the idea is that you don't have to write for the sake of writing. It's really if you have something that is actually going to be relevant for the question. So again, this is just kind of general guidelines to make sure that you try to, I guess, answer in the best possible way. Because again, every semester I have the same issue, because I know there are several students who have done the work and I've seen them in class and they understand the content, but when it comes to actually demonstrating it in the exam, it's a completely separate issue. So if you try to follow some of these points, it should kind of maximize the chance of you trying to, I guess, demonstrate that you know the content effectively. So again, now I'm just going to blaze through the first 5 weeks. Again, it is quite a lot of content, so I've just tried to highlight some of the most important parts. So in the first week, we basically just had an introduction to valuation, why we do it, what are some of the different approaches. And again, for example, we talked about that there's different approaches that you can take to valuation. So the primary approaches that we're looking at in this class is really related to either intrinsic valuation or relative valuation. And again, the intrinsic valuation approach is to try to truly understand the value of an asset or a business. So I gave you guys the example, I think, of buying a house as an investment property. So if you were to do an intrinsic valuation on an investment property, you try to essentially understand all the potential cash outflows and inflows from this investment property. So you try to effectively model the future rents, you try to model the future maintenance costs and all these things to get a true understanding of all the asset characteristics, because this tends to give you what we would consider to be more in line with the true or real value. But again, what we also need to remember is that the true or real value will not always be equal to the market price. So market price and value are two different things. Price is what you pay, value is what you get. So there are two distinct concepts. And on the other hand, we have the relative valuation, which is really just trying to understand the value of a business or an asset into relation to something that is very similar. So again, the idea is that similar assets should sell at similar prices. And the best example here is to just valuing a business at a multiple. So valuing a business at a multiple means that you're looking at a business, let's say, for example, earnings, and you're going to be valuing it at a multiple of that earning. And that multiple you get by observing other similar businesses that have sold recently, and you essentially extract how many times their earnings have they been paid for their business, and you're applying that multiple to your own business. And again, this will still not be equal to market prices. But again, the idea here is that you have two different approaches. And again, the whole reason why we do valuation is we're trying to understand the true value of a business. Again, this class is very much focused on the business case, in the sense we're trying to understand what a business is worth. But even if we think about it as a subset within accounting, there's a lot of things on the balance sheet that is valued using some form of an intrinsic valuation model. So in order to understand whether you can trust those numbers, you kind of need to understand the process that you go through in determining that in order to essentially be able to evaluate whether it's a justified valuation or not. We also talked about, I guess, the differences in the approaches to valuation, in the sense that the valuation method does not always lead to the exact same outcome, because it kind of depends on which perspective you take. So if you value a firm as a going concern, in the sense that it's going to continue on forever, we're going to usually have a higher value, because what that means is that the firm will tend to continue using its assets to maximize the value of those assets. Essentially, it will continue to use its assets to try to make sales, for revenue, and so on. So the idea is that the firm will be able to generate additional value. Whereas if we take the liquidation value approach, we essentially assume that the business will be sold, and we essentially chop it up, sell it into pieces, and essentially kind of finish our job. Again, generally speaking, we say the going concern value will be higher than liquidation value because of things like asset synergies. Because again, if you sell two separate assets that you own, you might get a certain value for them, or I guess a certain amount that somebody pays for them. But if you were to manage them through your own skills and have some form of asset synergies, well, then usually that should lead to an increase in value. But again, it just means that you have to consider whether you're going to be continuing the firm or not. One of the things, I guess, that we talked about, and I guess a few slides back, is I said that there's differences between the market price and really the value. So the market price is to some extent related to the value, but it doesn't have to be exactly the same thing, because again, there's sometimes bubbles in the sense that people overestimate the value of goods and businesses and so on, which means that we don't necessarily always know, or I should say we'll never be able to know the true value of any form of asset. The true value is essentially unobservable. So you see this little equation here, and I know some of you might hate equations, but the idea behind this equation is that in general, what we can observe is really the P, which is really the price that you see in the market. Now, whatever valuation method you choose, what you as a valuer or an analyst comes up with is a value estimate. So what you believe is the mispricing is really your own estimate minus the current price. So that's what you believe the current mispricing is. And that mispricing, what you believe it is based on two parts. One of them is based on the true value minus the price, which is really the true mispricing. But because you can't observe this is really just a theoretical concept, means that you essentially have to correct for your own mistake. And your own mistake is essentially the difference between your own valuation and the true value. So essentially you have the idea that there are mispricings out there, and that is kind of the purpose of this class, is to identify any mispricings. But those mispricings will be based on the true underlying mispricing plus your own error. So again, you as an analyst will never be able to know whether you're right or wrong. It's just an estimate in the end. We also talked about ethics in valuation in week one. So I mentioned that there are a few different standards for, I guess, being ethical when you're valuing a business. And there is the International Valuation Standards Council that has a number of fundamental principles that you should try to, I guess, adhere to in order to act ethical. And again, no matter kind of which profession you go into, even if you go into tax or whatever, or accounting, CPA or CFA, you will have to follow some form of ethical principles. And again, they tend to be very similar across different professions. When it comes to valuation, there are things like integrity, objectivity, competence, confidentiality, professional behavior, and all of these things are important. But generally speaking, what I find that in real life, objectivity is probably the one where you're going to have the most trouble adhering to, because it's really hard to be completely objective. And the reason for that is really that you will always have some form of a bias, and you will always have your own kind of interest at heart. So again, if you start to work for a Big Four firm and suddenly a client wants you to value their business, you're gonna have your own interest at heart to some extent. So on one hand, you should try to provide them with the most objective valuation. On the other hand, you might have another bigger client that would be interested in buying this business. In which case you start to think about, okay, so if I please this other bigger client, they're going to be happy with me, they're going to try to bring me more business, which might actually lead you to undervalue the original client. So the idea is that you'll almost always have issues with objectivity no matter what you do. And again, there are certain instances where it's more apparent and others where it's not. So again, where it's more apparent is, for example, when you might be asked to perform a valuation both for the seller and the buyer. And again, you're going to have an issue in the sense that you're going to go with the one that's going to provide you with the best long-term benefit. So usually what that means is the buyer, because the buyer tends to be a business that is an acquisition spree or some form of firm that's going to buy several times over in its lifetime. So again, generally speaking, objectivity is the one that we have the most problems with. Again, the first week was really just an overview. We also talked about, I guess, takeovers and I guess the focus of the group project, and the idea that most takeovers happen for a number of different reasons. Generally speaking, we find that the companies that get taken over tend to be performing kind of under expectations. So that's the general rule, but again, there's always going to be exceptions. So generally speaking, when we see a takeover happen, it's one, because the company could be doing better, but there's also usually some additional underlying reasoning. So for example, a firm might want to realign strategically in the sense that, again, if you're thinking about car manufacturers, when we have car manufacturers trying to go into autonomous driving and basically self-driving cars, the easiest thing to do for them is to just take over an existing company that is developing this technology. Because again, developing it yourself is hard, buying somebody else is easy. You also have, I guess, some things around deregulation, because when deregulation happens, what that means is that you tend to be allowed to own, I guess, companies in multitude of industries that might be related. So I think for the longest time in Australia, I think there was a rule that you couldn't own like newspaper, radio, and TV at the same time. Deregulation happened, and essentially you are allowed to do this. And again, there's a bunch of different reasons. If we look at, for example, financial consideration, it's just that it's an undervalued business, or that interest rates are falling, which means it's just cheap to buy. But the idea is essentially there's multitude of different reasons for takeovers that could effectively explain why they occur. Now, in week 2, we started talking about accounting analysis, and we basically decided that accounting analysis is something that we need to do before we touch any of the numbers. So again, when we value a business, we're valuing it based on the financial statements. So before we even look at the financial statements from, I guess, a valuation perspective, we first need to understand whether we can trust the figures. And the idea behind this is because we know that accounting is based on accruals. So there's a lot of judgments being made that can essentially either overstate or understate income and so forth. So the first thing that we want to do is to really understand some of the discretions managers have, and this will help us evaluate the quality of the reports that they're providing and the quality of the numbers themselves, so the earnings quality. So again, the whole reason why we even need to do accounting analysis is because companies don't use cash accounting, they use accrual accounting. So again, accrual accounting, the difference between cash accounting and accrual accounting is really the timing. So essentially the only difference is that under accrual accounting, we can effectively recognize revenue before we receive cash, and we can recognize expenses before or after we receive, I guess, pay cash as well. So the idea is that because there is some discretion involved in this, there might be some potential issues for manipulation. We also talk about the idea that management manipulation or management accounting choices is one issue, but generally speaking, accounting numbers will always be biased because of 3 reasons. For one, you generally have noise from accounting rules. So in the sense that accounting rules are imperfect. So the best example of this is R&D. So generally speaking, from an investor perspective, you want to make sure that the accounting numbers that you're getting are the best reflection of the company's performance and position. Accounting, on the other hand, tends to view, I guess, some of these choices as a bit risky. So for example, R&D. So under accounting rules, there's very few instances where you can recognize research and development as an asset. Instead, you have to expense it. From an investor point of view, on the other hand, most investors view research and development as an asset because it's going to be generating future revenues. From an accounting perspective, we're essentially being conservative here and saying, well, there's so many discretionary items regarding to research and development, so it's just going to be expensed. And by expensing, you're essentially creating noise for investors because they essentially need to adjust those numbers to essentially reflect that research and development is an actual asset. We also have issues around forecast errors. So for example, when we're thinking about estimating accounts receivable and specifically trying to figure out the bad debts and specifically the provisions, we generally have to forecast some form of default rates for our credit sales. And again, people can't predict the future, so you're always going to have some form of mistake there. So really the forecast error, it's not something that you want to be doing any form of manipulation, it just happens because you can't predict the future. And then finally, we have managers' accounting choices, which is really the focus of this week, and the idea that the manager could, for example, inflate earnings to maximize their own compensation package or something similar. And again, we talked about all these various reasons for why a manager might have an incentive to manipulate their, I guess, accounting statements. So for example, debt covenants, in the sense that they might have debt covenants attached to some form of liabilities that they have. So they might have taken out a bank loan and the bank said, you're getting a 5% interest rate as long as your debt to asset figure does not go above 70%. If it goes above 70%, maybe the interest rate goes up. If it goes up to 75%, then it's a technical default and you have to repay the principal immediately. So effectively what that creates is a situation where the managers always have an incentive to try to minimize debt to assets. And again, if you think about the idea that they're going to have choices when, with relation to, for example, depreciation, they might start to think about in terms of which depreciation methods is going to affect my debt to asset ratio the most. So which one is going to maximize it, which one is going to minimize it. And again, all those things will kind of lead to some form of earnings management. And again, we have a whole bunch of different raising compensation contracts being probably the most obvious in the sense that managers sometimes get paid based on how they perform, and that performance is sometimes measured by accounting numbers. Effectively, because of the choices that they have under the accounting standards, they can more or less manipulate how much they're going to get in terms of compensation by trying to maximize profits. But again, these are just some of the underlying incentives. We also talked about, I guess, the quality of financial reports and really the quality of earnings itself. And really the idea here is that what we want to see when we're valuing in business is reports that provide us with information. So the financial reports are of high quality, but also that the earnings themselves are of high quality. And earnings quality is really the idea that the earnings that we see that are being generated by the company are sustainable and persistent. So essentially they're not one-off earnings figures, they're going to be persisting into the future. But technically, again, what we generally have is a spectrum in the sense that on one hand we have optimal information, on the other hand we have essentially fictitious transactions where the company is just making up things. But usually speaking, what we tend to have is some form of, be somewhere in the middle, or we do have to some extent some form of earnings management by management, in a sense that they're trying to inflate or deflate earnings based on what what their incentives are. And you might have some issues relating to the quality of the disclosures. But the idea is essentially that there is a spectrum here. We also talked about some of the examples of how you might manipulate some of these accounts. And the idea is that these might be essentially used as a way to understand where you need to look at if you want to do accounting analysis. So we gave the example, for example, of the aggressive or premature revenue recognition. So the idea is that when we have unearned revenue, we should only be recognizing it as we are earning it, as we are essentially realizing it. So again, if somebody prepays you for a service for the next 2 years, you should be recognizing it as you earn it. So essentially you consider it as an unearned revenue, so a liability, and then as you provide the service over the next 2 years, you take a portion of that and recognize it as revenue and so forth. Managers, because they do have some discretion in kind of justifying whether something has actually been earned or not, they can basically be aggressive and say, well, it is a 2-year contract, but in the first 2 months, we've already technically provided 50% of the service over its lifetime. So let's just take 50% of that unearned revenue and recognize it as revenue right now. So essentially being aggressive. What that leads to is essentially an overstatement of income. And what that also means for the balance sheet is an overstatement of equity because income goes into your retained earnings. Retained earnings is part of your equity. And essentially, it's going to be leading to an overstatement of net assets. On the other hand, we do also have conservative revenue recognition because, again, sometimes managers might want to actually push forward revenues into the future. And I think I gave the example of hitting sales targets. So sometimes managers or even employees might have sales targets that they need to hit. So in a sense that they might get a bonus if they reach $1 million in sales. If you know that in December you're never going to be able to reach that goal, what you might want to do is to be conservative in your revenue recognition and shift it forward to the next period. And the idea here is essentially you're going to be setting yourself up to hit the target next year instead, because there's no way for you to do it this year. Let's just shift it forward into the next year. And essentially the effect here is going to be the complete opposite. But the idea here is essentially that revenue recognition is usually where we have most of the issues related to manipulation when it comes to management. We could also seed around expenses. So for example, probably the most obvious one would be understating of bad debt expenses, because again, bad debt expenses are to some extent gonna be based on two factors. So one is actual bad debt, so people who are delinquent and they can't pay, so essentially you have to take out your provisions and write it off. But you also have the idea that you're essentially always going to be estimating your bad debts into the future. So whenever you make a credit sale this year, you have to recognize an expense this year. Yes?
So they could go both ways, right? With provisions and then accounts receivable?
Yeah, so you could technically do it the opposite in the sense that you can essentially understate or overstate the bad debt expenses. That's what you mean, or?
No, I mean, like, so like in one way it'd be understating of bad debts, like you didn't write off your bad debts.
Yeah.
Or you understated it in your like provisions?
Yeah, so essentially it's a two, so if you understate your provisions in the beginning,
Yeah.
you will usually have an increase in bad debts right off in the future because you have an understatement in the provisions. So it's kind of a two-pronged problem, that's correct. But the idea is because again, bad debt expense has a lot of judgment, so you have to estimate future defaults. You can essentially say, well, our credit policy is getting so great, so instead of putting aside 2% of credit sales as provision, we're only going to set aside 1%, which generally would mean that there's an understatement of bad debt expense for this particular year. And again, it would reverse in the future because you have to remember accounting is really just about timing. All we're doing when we're manipulating things is we're really just shifting things around in time. So if we overstate income right now, it's going to reverse in the future and lead to an understatement in the future. So you really can't kind of escape the reversal effect. What you essentially do is you just control the time of it. And again, depreciation, which is again one of the big discretionary accounts. If you understate depreciation right now, it leads to an overstatement of income. But again, if you understate depreciation right now, it will lead to you recognizing a higher depreciation sometimes in the future because you will use that entire asset over its lifetime. All you're doing is allocating to different time periods. And again, we have things like understated interest and tax, and again, all of these things, and in case these three examples, lead to overstatement of income. But again, these are really to do with revenues and expenses, but technically speaking, you can even manipulate cash flows. So traditionally speaking, people have tended to consider cash flows to be more safe in the sense that they're harder to manipulate, but you can do real actions. Essentially, you can do actual things in business to try to play around with your cash flows. So one of the things that you might do is to just defer the payment of payables because they will increase your operating cash flow this year. So what would be one of the problems with deferring payment of payables? So if you owe somebody money and there's like a deadline to pay, what happens if you don't pay it? Yeah, you'd be basically getting an extra charge. So you're essentially deferring into the future, but you're also getting worse off in the future. Not only do you have to pay it in the future, but you'll essentially get a penalty as well. But again, these are kind of like real actions that you can take if you really are concerned about maximizing cash flows in this particular year. And similarly, you could also want to accelerate payments from customers. So again, usually if you want to accelerate payments from customers, yes, you can call them up and say, please pay right now, even though you don't have to for probably another 10, 20 days. The way you usually incentivize them is by giving them a small discount by paying early. And again, you're maximizing cash flows right now, but you're doing it at the expense of not getting the entire bill, essentially, because you're giving them a discount. And again, things like deferring purchases of inventory, stupid business decision long term, but if you just care about right now, it's very easy to essentially do this to maximize cash flows for this particular period. So again, cash flows can still be manipulated just like accounting figures, but when it comes to cash flows, you actually have to make real decisions in terms of your operations to essentially impact them. We did talk about some of the pitfalls in the sense that technically speaking, conservative accounting may also be misleading. So we tend to focus on a lot of on like aggressive revenue recognition and all of these aggressive actions in the sense that which tend to lead to an overstatement of assets. But from an evaluation perspective, conservative accounting is also bad because conservative accounting gives you false figures. In the sense that conservative accounting tends to understate assets, tends to understate profits, if you're getting numbers that are essentially understated, it will still be very difficult for you because you as an analyst, or when you're trying to value a business, you're trying to understand what is the true value of this business. If the numbers are biased upwards or downwards, it's both going to create problems for when you're trying to value the business. We also, I guess, talked about the idea that technically speaking, not all unusual accounting practices are questionable. So sometimes some firms may have a specific policy that might seem strange because nobody else in the industry is doing it, but it doesn't mean that they're doing something wrong. And then finally, we have the idea that common standards does not lead to common practices, in a sense that, yes, it is easier to compare companies that both report according to IFRS versus comparing a company that reports according to IFRS versus one to GAAP, or US GAAP specifically. But even within IFRS, there's going to be differences between countries because of culture, because of all these various issues, which might lead to the fact that in some countries, conservative accounting is much more prevalent than in others. So just because both companies are reporting according to IFRS does not mean that their numbers are going to be exactly comparable, because there won't be common practices across countries. We also talk about the notion of earnings quality, and again, earnings quality is really the idea that the number that we see for the profit, for the earnings, is something that we'll probably might see in the future. So essentially we're assuming that this is going to be recurring. So if something is going to be recurring over time, it's good quality. So on the flip side, bad quality earnings or poor quality earnings would be a manager trying to maximize earnings in this particular year by using one-off items. So one-off items might be restructuring charges. It might be selling off assets to kind of maximize earnings right now. But the idea is that what we want to see when we want to see high quality earnings is really that they're going to be recurring into the future. Because again, when we value a firm into the future, if we have recurring earnings, we know that we can trust that this will kind of persist into the future. Which kind of leads into the second point, which is really to do with earnings persistence, because high quality earnings really generally just means that the earnings are going to persist over time. And persistence can be measured from a, I guess, quantitative perspective, in a sense that it's the ability of reported earnings or income to predict companies' future earnings. So essentially you can view it from this kind of equation format. So in the sense that earnings in the next year is related to the earnings this year. So the higher your beta coefficient is, generally the more persistent your earnings is, because that's going to be showing the strength of the relationship between this year's earnings and next year's earnings. So again, there's a bunch of different things that could indicate earnings qualities. For example, beating benchmarks, in the sense that you could be essentially more or less performing above industry norms. You could be performing above what people expect of you as well. So if an analyst predicts that you make $1 million in profit this year, you make 1.2, you're essentially beating benchmarks. And then obviously you do have some after the fact confirmations of poor quality. So you have things like enforcement by different agencies depending on which jurisdictions you're in. It could be restatements, which are much more common in the sense that you're essentially restating your prior period financial statements because you found some mistake. So whenever you have a restatement, it generally indicates that there's some issues around with your accounting policy in the past, which again is an indicator of poor earnings quality. Again, we also talk about the cash flow quality idea, in the sense that technically cash flows have been historically considered to be safe, but even they're susceptible to manipulation. Generally, we want to see high cash flows from a company because high cash flows is a good thing. And if you remember, one of the red flags that we talked about is really the differences between the operating income and the operating cash flows. Because generally speaking, cash and accounting profits should be the same. The only difference is timing. So over a longer period, the ratio should be 1-to-1. So if you constantly see that you have much less cash profits than accounting profits, it's somewhat of a red flag. But generally speaking, when we're looking at cash flow quality, we do have to consider things like the corporate life cycle, because in the beginning of a company's existence, it will usually have really poor operating cash flows because it will tend to have a bunch of expenses, but not a lot of revenue. So essentially has a bunch of outflows, but very little inflows. But essentially what we want to see is, again, the idea that the cash flows are from sustainable sources. So they're going to be sustained over time. If we see low volatility, again, it's a good thing in a sense that if we see cash flows that are not that volatile, it's a great thing. But again, the volatility thing relates to earnings and all the accounting figures as well. Because when you see volatile figures, it means that you can't necessarily predict the future that well. So it's kind of the same idea. And then finally, we had balance sheet quality issues in the sense that you could have understatement or overstatement. Generally speaking, when we're looking at managerial incentives, they tend to lead to understatement of things like inventory, PP&E, might lead to an understatement of impairment, which will impact things like inventory, PP&E, and goodwill. Probably the most common example is around goodwill. So goodwill is something that you get when you acquire a company in excess of its book value. So essentially the goodwill is the difference between the book value of the company that you acquire and what you paid, because that's the difference that you need to somehow account for on your own books, and that goes into an account called goodwill. Over time, if the value of goodwill decreases, you need to write it off. And by the value of it decreases, what essentially that means is the company that you've purchased has decreased in value. And because valuation is very subjective, it's quite subjective whether goodwill has actually decreased or essentially over time or not. So again, because of all these choices, it might lead to goodwill being overstated. So again, there are a bunch of different issues around different balance sheet indicators. Generally speaking, it will be around understatement of impairment charges, so impairing inventory, or essentially writing off bad inventory, or writing off bad assets, or understatement of contra asset accounts. So again, your allowances for doubtful debts, your deferred tax asset valuation, and so forth. But the idea here is, again, managers and accountants have a bunch of choices that could lead to them doing bad things, and these are some of the pathways for how those bad things could be done effectively. We then went into ratio analysis, and the idea here is essentially, again, if we're looking at valuation as a process, we first just had a basic understanding in week 1. In week 2, we said that before we start looking at the numbers, let's see if we can trust them. If we think that something needs to be adjusted, we would do it at the end of the accounting analysis. So for example, if you thought that goodwill was overstated, you write it down before you start to analyze the company's numbers. So when we're looking at financial ratios and using any form of ratio analysis or financial analysis, the idea here is that we're trying to understand why things have happened in the past. So we're not really interested in the fact that return on equity is 15% or 20%. We want to know why it's 15%, why it's 20%. So there's a whole bunch of ratios out there, and again, you've received a formula sheet for the exam. And generally speaking, these formulas can be categorized into these 4 different categories, because these 4 different categories tend to look at slightly different parts of a company's past performance. So we have things like activity ratios, and activity ratios include things like asset turnover, and that's really just about how efficient the company is at using the assets to generate sales, to generate profits, and so forth. We then have things like liquidity ratios, which are really about the short-term obligations of the business. And again, one of the examples here would be the current ratio, which is really your kind of the ratio of your current liabilities to your current assets. So generally speaking, you want to have more current assets than current liabilities. So you want to make sure that that ratio is above 1. And again, we then kind of can move on to a more long-term perspective. So in terms of looking at liquidity, which is short-term obligations, solvency is more to do with long-term obligations. So you're looking at your liabilities to your assets, or your interest-bearing debts to your assets, and so forth. And then finally, we have profitability ratio, which is really just the overall view of the profitability of the firm. So essentially, are you achieving a return on your investment? And what we did in this week is that we really started with this profitability part, and we said that generally speaking, the most important ratio that we could look at when evaluating a company's performance is the return on equity. So the return on equity, if you view it from a hierarchy perspective, is at the very top. because that's going to give us the overall profitability of the firm. Because from a shareholder's perspective, it gives you the return based on how much you've invested into the business. So if you're getting a negative return based on how much you invested into the business, it's a bad thing. So you always want to be getting a sufficient return based on your investment to compensate for essentially the opportunity costs. So we did say that return on equity is the top of the pyramid, so essentially it's the overall view, but it doesn't necessarily tell us how a company achieved that level of profitability. So we said that generally speaking, a company can become profitable in many different ways. So we said that we can, traditionally speaking, decompose return on equity into two parts. So the first one is your return on assets, and the second one is your leverage. Which means that if a firm wants to increase its overall profitability, it can try to increase its return on assets or try to increase its leverage. And the idea here is essentially that return on assets is more focused on the business strategy, versus the leverage is really a more financial strategy. So one of them tends to be easier in the sense that business strategy and trying to increase return on assets is a lot more difficult than trying to just borrow money to fund more growth. So when we're looking at comparing different companies, just because they have the same return on equity does not mean that they're equally good when it comes to their performance. Because what we want to know is how did they achieve that performance, and is that performance sustainable over time? So again, when we're looking at return on assets, we could look at return on assets in many different ways. One of the things I guess that's probably quite important for this week is really the idea that when we're looking at any of these ratios that compare a figure from the income statement to that of the balance sheet, is that we average out the balance sheet item. So in a sense, we take the average assets. And the idea here is that the balance sheet is a snapshot in time. Whereas if we look at the net income, it's a flow throughout the year. So essentially what we're doing here is we're comparing two very different figures. The way we get around it is we take the beginning assets, the ending assets, average them out to understand what is the average amount of assets that we held throughout the year. Usually this is not going to be a big issue, but if the company has acquired a lot of assets throughout the year, so there's a huge change, it will impact the ratio. But the idea here is that really what we're looking at when we're looking at return on assets is really, has the company used its assets well to generate net income? So partially this reflects how good the company is at managing its operations. But technically speaking, it also is kind of a bit of a noisy measure because it also includes things like interest expense. And interest expense is actually something that is more or less related to your financial strategy. So it's a bit noisy. And two, it also includes the effective tax, which also creates a bit of a noise because again, tax is more or less something that is forced upon the company. It's not something they can more or less try to manage with a business strategy. So again, return on assets might not be the best measure of overall execution of business strategy. But again, when we're looking at return on assets, that's essentially, and financial leverage, that's basically the second level of the pyramid. So again, first level, return on equity, second level, return on assets and leverage. And then we have the third level in the sense that how did the firm actually achieve its return on assets? And we can decompose it into two parts, which is the net profit margin and the total asset turnover. And the idea here is that we can try to understand how a company is achieving a certain return on its assets. And again, what they can generally do is they can either try to go after high profit margins or have high turnover or efficiency. In most cases, a company can only focus on one, because if you focus on one and try to maximize one of them, there'll be trade-offs with the other one. So again, to get a higher profit margin, what you generally need to do is increase prices. As you increase prices, what generally happens is that consumers start to demand your goods less or your goods and services less, which means that your turnover will decrease. And again, if you try to increase your turnover, usually that's going to also lead to a decrease in profit margin, because the easiest way to increase turnover is to slash your prices, because that will increase customer demand. That will increase turnover, but decrease profit margins. So when we're looking at any business out there, we can generally kind of look at these two ratios to understand what the strategy of the business is. So if I look at H&M will have very high turnover, but they'll have low profit margins in the sense that their margins for their, I guess, activities tend to be smaller. Whereas if we compare it to a company that might be selling a more luxury type of item, so Armani, Gucci, or whatever, they'll tend to have a lower turnover but a higher profit margin. Because that tends to kind of show whether you have a cost leadership strategy or if it's a differentiation strategy. So if you look at H&M, it's more cost leadership, whereas if you look at the high-end market, it's more differentiation point of view. But the idea here is really that there is a link between strategy and profitability. So when we're looking at explaining past profitability and past changes, it's directly linked to the company's strategy. So again, when we're looking at return on equity, we could effectively then view it as a function of these three parts, so profit margin, turnover, and leverage. So if you want to increase your overall profitability, you can try to either have high margins products, so essentially you can try to increase your margins. You can try to improve your efficiency by, again, increasing sales in relation to your assets, or you can just try to borrow more money to fund future growth because that will increase your leverage. The idea is essentially you have different trigger points for trying to improve your profitability. So again, from a, yes?
If we would look at return on equity and look at two different companies,
Yes.
and one would have the return on equity due to its leverage and the other one due to its return on assets.
Yeah.
Would we say the one having the ROE due to its return on assets is the better performer, or would we just say it has better operations, but the other one is using its financial, like it had, you know what I mean?
Yeah, no, I know what you mean. So basically the idea is that, so I think it's kind of similar to this in the sense that we have an example here with three different companies, and they're all achieving the same return on equity, but they're doing it in different ways. So if we wanted to comment on their performance, generally speaking, it's kind of up to debate depending on who you are. So generally speaking, their end performance, so their overall performance is the same, so they're returning the same amount of percent on the equity investment. But how they're actually getting there is slightly different. So in a sense, the company A is doing it by maximizing margins. Company B is by doing it primarily through the maximization of leverage, and company C is maximizing the turnover of the firm, so essentially asset efficiency. So they're arriving at a different ways. You could try to analyze it from a perspective of saying that, well, technically leverage is risky, so risk is not good, so maybe I prefer this one because it has the same final return by having the lowest amount of leverage. But technically speaking, there is such a thing as having too little leverage. So if you have too little leverage, what it generally means is that you're essentially missing out on opportunities. So for example, company A could effectively be risk averse, so essentially they're trying to avoid risk. But if they could take on more leverage, what they could effectively do is increase their return on equity very easily. Again, that's one perspective. You could also then tie it to the things that you might have learned in the forecasting week and mean reversion. So we talked about the idea that when we're looking at mean reversion, profit margins is what reverts back to the mean the most. So in the sense that if you want to evaluate this from a long-term perspective, so which one should I invest in? You might say, well, profit margins tend to revert back to the mean the most, whereas turnover and leverage tends to be more stable. Which means from a long-term perspective, I actually want to avoid the company that's getting that return on equity through high profit margins because they will revert back to the mean, which means that in the future, this profit margin will go down, and in the future, this one will tend to go up. But again, these are just guesses, but essentially what that means is that you can more or less debate whatever you want here. There's no real right answer. There's really just showing your understanding of some of the various nuances. But again, the idea here is that we're just trying to decompose the profitability to see what drives it. Because if we see what drives it, we can then try to understand whether we can try to improve it over time. So if I do see that a company has very little leverage, so assets divided by equity is 1, it means that they have 0 debt. So it effectively means that they're not borrowing any money from the banks. And again, this is very, very common for smaller to medium-sized businesses that tend to avoid debt because they don't need it. They've been profitable in the past. But what that also means is that they're essentially losing out on growth opportunities because by borrowing money from the bank, especially when it's cheap to borrow, it's going to create a very easy pathway to future growth, which is again good for shareholders. Probably the highlight of this week was really the idea that computation is not analysis. So just by computing ratios does not mean that you can essentially explain what's happening. So knowing that return on equity is 15% is not enough. What you want to know is how did the firm achieve its return on equity? And again, one step further is, for example, trying to understand how did the firm achieve its net profit margins? And again, what that generally means is that you're trying to understand the line items that are causing the increase or decrease. So for example, if I saw that the net profit margin here went up from the past year, I would then look at its net income and sales and see which one is driving it. So if it is, let's say, net income that increased, I would then try to understand why did net income increase whereas sales kind of stayed the same. So it could be, for example, that their expense management got better and so forth. So you essentially try to understand why things occur rather than just the fact that they did change over time. So changes in ratios is not necessarily that interesting from an analysis perspective. It's why they changed over time. And again, what we're generally looking at is really how well the company performed. And you could try to look at it from its own history and relative to its own competitors. And the idea here is that you're trying to understand why and really whether the strategy is causing that performance or not. Because again, strategy is the most important part when it comes to the company's performance because that is going to be essentially changing the way a company performs over time. Some of the kind of issues when it comes to ratio analysis is that technically speaking, you do have some computational issues. You do have some issues related to the relevance of certain ratios in a sense that not all ratios are always relevant for all companies. So for example, in the formula sheet, there's probably like 30, 40 different ratios. Not all of those are going to be relevant for all companies. So if you're looking at, for example, asset turnover, well, asset turnover is mainly going to be relevant for companies that are going to be, I guess, asset heavy. So if you're a service firm, it doesn't really matter how much in assets you have or what your asset turnover is because it's not something that is kind of critical to your own performance. We do have some issues around computation. I did mention the fact that, for example, if you try to divide two negative numbers, you get a positive ratio. It doesn't mean that you have a great performance. So again, if you have a negative retained earnings, you have a negative equity in the end maybe, and you compare it to a negative profit, divide them, you get a positive return on equity, which again does not reflect what actually happened. So you essentially always have to consider what you're doing. So the idea here is essentially there's a bunch of different ratios and you need to understand in which scenario do I need to focus on different ones. We then move on to risk analysis. Do you guys want to break? Yes. Cool. Let's see. All right. Sorry.
Change in the corporate tax rate, like in the marginal tax rate every year. That's not like doing arbitration when you actually calculate it.
Okay, so basically, generally across the world, tax works on a cash basis. So your accounting profits and cash profits is different, but then also you have all these tax structures that you want to do. But the biggest reason is the cash. Yeah. All right, so let's continue with the review. So after week 3, we went into risk analysis. And again, the whole idea behind risk analysis is that we're going to be looking at some of the various aspects of the underlying risk of the business. And the idea here is that this is going to lead to some conclusions that is going to help us in our forecast. So we talked about the idea that there are things that are generally disclosed when it comes to risks, and there are things that are non-disclosed. So we have disclosed risks in the financial statements, in the notes, and these might be things like commodity prices and interest rates, litigation, reputation, and all the potential things that could impact the company's performance. But there will be some issues that are non-disclosed, which is really what we focused on in this particular week. And the two non-disclosed risks that we focused on were the bankruptcy risk and the financial reporting manipulation risk. And both of them we're going to be looking, and I guess we looked already, at using quantitative models to try to estimate the probability of these two things occurring. So again, bankruptcy risk is the first one that we looked at, and the idea here is that a company is to some extent always going to have some form of probability of going bankrupt. When we're looking at taking over a business, when we have a takeover situation, looking at bankruptcy risk is very important because you tend to take over companies that are underperforming. So some of that underperformance might actually also mean that the company has a very high probability of bankruptcy. Because of all these issues, and just because bankruptcy is such a big corporate event that it leads to so many losses, there's been a lot of research on trying to predict bankruptcy. So can we somehow predict whether a firm goes bankrupt or not? And based on this, we can basically either short the stock on the market to try to essentially make money, or if you're from the bank's perspective, you're just not going to lend them any money. So the idea is that if you can predict bankruptcy, you can essentially make money. So back in the 60s, they kind of tried to start to understand how you could try and predict bankruptcy. So one of the first things that they did back then is to just look at a few different ratios and compare firms that went bankrupt with firms that did not go bankrupt. So Beaver, back in I think 1960 sometime, he looked at about 80 bankrupt firms and 80 non-bankrupt firms, and then compared them across a bunch of different ratios. So basically across I think 29 different ratios. And they found that there were 6 particular ratios where there was significant differences between those that went bankrupt and those that went those that basically continued operating. And the idea here is that if there are significant differences between these ratios, between these two groups, of bankrupt and non-bankrupt, we can use these as indicator of bankruptcy probability. So if we know that, for example, if we're looking at net income and total assets, generally speaking, firms that going bankrupt have a negative profitability, whereas firms that are going to continue operations generally have a positive profitability. Firms that went bankrupt generally have bad liquidity. So their current ratio, so their current assets divided by current liabilities, is generally below 1, whereas firms that did not go bankrupt generally are above 1. So basically it's a lot of common sense here, but the idea here is essentially that there's statistical differences between bankrupt and non-bankrupt firms across these 6 ratios. So again, this is basically the first approach, and this is a univariate approach because essentially you're just looking at one ratio at a time to see whether there are differences. But you don't necessarily know the relative importance of each ratio. So in the sense that we do have some drawbacks when it comes to univariate models because it helps us to understand what is associated with bankruptcy, but it doesn't tell us how important each one is in relation to the other. So for example, is profitability much more important than liquidity, or is it the other way around? And we don't know how we could kind of combine various combinations of these. So for example, you might have high profitability, but really, really low liquidity. And you might have high profitability or low profitability, but really high liquidity. So how do you combine these, and how do you essentially try to merge these two kind of contradictory ratios? So because of this, people basically went on to develop multivariate models. So multivariate models, and the one that is most known is the Altman Z-score. So essentially it was developed back in '68, and it looked at multiple ratios at one time. So essentially it's looking at a linear combination at various ratios that can essentially help you to try to understand how you might combine them to try to get some form of a prediction score. So we basically went through this model, which is basically the Altman Z-score. So the Altman Z-score basically looks at a few different ratios, and it's basically estimated by using a regression. So if you go back to your statistics class, when you ran regressions on SPSS or eViews or whatever you used, you would have done something similar to this, or at least you could have done something similar to this, in a sense that you're basically looking at the probability of default with the various levels of different types of ratios. So what Altman essentially developed was a Z-score model which provides a weighting for each various ratios, in the sense that we have things like net working capital divided by total assets, we have retained earnings divided by total assets, and each ratio for your particular company is then multiplied by the coefficient. So again, if you remember from when you ran regressions, you would have gotten coefficients, significance levels, and all these things. So that 1.2, 1.4, that's essentially your coefficient or your beta in your regression. So the idea here is that you essentially are able to combine these 5 different ratios to get a final z-score, and then you compare that z-score to these particular cutoffs. And again, if you remember back from the homework, we did talk about the idea that just because one of these coefficients is 3.3 and the other one is 1 does not mean that the 3.3 is 3.3 more times important than the sales divided by total assets. Because generally speaking, when we're looking at their contribution to the probability of default, we also have to consider what is a normal range for this ratio. So sales divided by total assets, generally speaking, might be like 200% on average. So it's going to be 2. Whereas if you're looking at earnings before interest and tax divided by total assets, might be 10% on average. So they're vastly different numbers. So this one is not necessarily 3.3 times more important. It can actually be less important once you consider the normal range for that particular ratio. But the idea behind the Altman model is essentially you're combining many different ratios at one point in time to get basically one single probability of default. And again, if you're looking at some of these different ratios, we have things like asset turnover, we have profitability, we have past profitability, we have basically your leverage and so on. So it's looking at many different aspects of a company's performance, and it's quite easy to understand. And I mentioned that there's a whole range of other models been developed after this that are much more complex. They might have 20 different ratios, but they're not necessarily that popular because they're a bit too complex, whereas this is very easy to understand. So when we're looking at the Altman z-score, what we need to kind of consider is with most of these quantitative models, there's going to be some drawbacks. So with the drawback when it comes to this one is really, it's a very, very old model back from 1968. The sample of firms was US manufacturing companies, and there's only 66 firms, so essentially half of them went bankrupt, half of them did not. So essentially the model is based on a very, very tiny sample size. So if you remember from your statistics class, generally the higher your sample size, the better, because the higher your sample size, the more likely it is that then kind of the result will be kind of representative and generalizable to kind of outside just this tiny little sample. And again, what we're looking at is a linear combination of business ratios weighted by coefficients. And again, there are a few drawbacks, which I'll talk about in a few next slide, but technically speaking, Altman did also address some of these drawbacks in the sense that he did develop a model for the non-manufacturing sector, he did develop a model for the private sector and for emerging markets. So they did try to address some of these underlying issues. But the idea here is that most of these models will have drawbacks, but generally speaking, they tend to look at very similar things. So if you look at 10, 20 different models, most of those ratios that they're using can be kind of tried to put in any of these categories. For example, what is the relative liquidity of a firm's assets? So having liquid assets is much better than having illiquid assets. But on the other hand, we also know that having liquid assets generally means that you're generating a lower return on them. So if you know that, for example, a firm needs working capital, so you need current assets versus your current liabilities to essentially operate, but that working capital is not necessarily generating a return. But that working capital does, on the other hand, mean that you have high liquidity. We could look at things like asset turnover, just like the Altman model did. We could look at the financing factors, in a sense, what is the proportion of the leverage of the firm, so what is the proportion of debt in general, and then what is the proportion of the short-term debt, because short-term debt and long-term debt are different concepts. And again, we could look at things like what is the profitability, and again, if you look at the Altman model, we have profitability here, we have leverage here, we have asset turnover here, so it is looking at a lot of these different ratios. Things like variability of operations, in a sense that, again, volatility, generally speaking, bad. And when we're looking at some of the other possible explanatory variables, size, larger firms tend to have more options. So if a large firm is in decline, is in trouble, they have a whole range of different banks they can try to approach. They can even try to approach really big institutional investors. Whereas if you have a small business, it tends to not have that many banks that they can approach to try to get more financing. So generally speaking, the larger the firm, the more safe it is, and so on. So the idea here is that there's a bunch of different factors that you could look at to try to understand what could kind of be an indicator of bankruptcy. We also then talked about financial reporting manipulation risk in this particular week, in the sense that we have two undisclosed risks. One is bankruptcy risk. The second one is financial reporting manipulation risk. To some extent, this is very much linked to week 2 when we did accounting analysis and the red flag analysis, except in this case, again, instead of just looking at one indicator at a time, we're looking at a combination of them to try to understand how they essentially play together. The most probably commonly used model out there when it comes to the manipulation risk is the Beneish model. And again, the Beneish model is very similar to the Altman model in how it is developed, because again, it's based on a sample of manipulators and non-manipulators in this case. He then looked at a combination, essentially a linear combination of 8 different ratios in here, and essentially to get a M-score. And that M-score is again compared to some form of a cutoff. And the idea here is essentially you're going to be able to estimate the probability of a company engaging in any form of manipulation. So again, when we're looking at the M-score, it's a bit more complex in the sense that you have 8 different ratios, and they're not always self-explanatory because I guess even the abbreviations are not that easy to understand. So again, we do have a bunch of different explanations for each one and why that might be an issue. But generally speaking, what we have when it comes to the Beneish model is different red flags in combination. So each one could be seen as a red flag kind of ratio. And what he's done here is combine them. And what you see is that a lot of these ratios are index ratios. And index ratios generally look at the change from one year to the next. So essentially, we're looking at changes from one year to the next to basically see how things have, progressed. And the idea behind this is really that when you're looking at manipulation, it generally is something that you can pick up by changes in behavior. So again, if somebody's stealing from your business, one of the easiest way to understand who's stealing is who's changed the way they act, who changed the way they behave. And similarly, when we're trying to understand earnings manipulation, that is also the reasoning why a lot of these ratios are changes from year to year, because you're basically trying to find any major drastic changes in these ratios. So again, there are 8 different ratios. What I would try to focus on when you're studying is not exactly the definition, but really trying to understand what is it capturing and why is this an issue. So for example, accruals is really just the measure of how much we have in accruals within the business, so accounting terms. And the idea is that the higher accruals could indicate higher earnings manipulation, because when you manipulate depreciation, whenever you manipulate any of the accounting items, that will generally lead to a higher accrual figure. Again, things like depreciation index, the idea that we have a decline or an increase in the depreciation rate will be an indicator, because if you have a decline in depreciation rates, it might be meaning that you might be manipulating. Because again, if you switch depreciation methods to try to decrease the depreciation expenses, what that will lead to is a decline in depreciation rate. So all of these different items have some form of a logic behind them. I did mention that even though these are quantitative models that are widely used, most of them have significant drawbacks. So in the sense that, generally speaking, you could take a qualitative approach or you can take a quantitative approach. Some people prefer one or the other. I tend to prefer the qualitative approach, and the reason is because a lot of these quantitative models, they tend to give you a false sense of security because you're getting numbers at the end, you get percentages at the end, which might seem more objective. But generally speaking, a lot of these quantitative models, they have a bunch of different issues with them. For example, sample sizes, in the sense that most of them have been developed on very tiny little sample sizes. So the Beneish model, what was it, 74 manipulators and 74 non-manipulators. In the world, there's like millions upon millions of companies. So the fact that this sample is just based on about 150 firms means that there's a high probability that these 150 firms might not be representative of all other businesses out there. So essentially that small sample sizes means that your generalizability might not be that great. Most of these models have been developed quite a long time ago. So again, sometimes this might not be an issue, but if things change over time in relation to what those ratios might look like, it might be an issue. So for example, when we're looking at the Altman model, one of the big things here is retained earnings divided by total assets. It's basically looking at your past profitability divided by your total assets. Back then, most firms had highly positive retained earnings. These days, it's actually quite common that you see publicly listed firms that are very large that have negative retained earnings, which means that over time, some of the data might have become irrelevant to some extent. We do have some issues around private and public in the sense that most of these models have been developed for publicly traded firms. Whereas again, private firms are the overwhelming majority of all firms out there. And then generally speaking, just the luck factor in the sense that we're just looking at statistical relationships. We don't know whether this is just by luck in the sense that the statistical package has found a pattern, but that pattern might just be applicable to this particular sample. So it might not actually be applicable to real life. Because again, when you're looking at some, I guess, more advanced models, and even when you're looking at some of these models, you have some coefficients that are positive, some that are negative. And just to a large extent, a lot of these make sense, but the more complex the model becomes, the more likely it is that you might actually have two measures of profitability. One might have a positive coefficient, one might have a negative. So they're essentially causing the model to go in different directions, even though they're both capturing profitability. And that is really because the model is picking up on a statistical relationship, but that might not be reflective of actual practice. So it might not actually be good for out-of-sample prediction. And then finally, we did forecasting, which we did last week, so it should be quite recent in your memories. And the idea here is that forecasting is effectively the first step in actually valuing a business, and all the things that we did before then is to try to help us to forecast a firm's performance in the most appropriate way. Generally speaking, what we say is that there is generally some form of a driver behind a firm's future performance, and these tend to be to some extent strategic drivers or just some operational drivers. So for example, what we're looking at here is really what can impact the firm's future performance. If I look at airlines, I'm generally going to be looking at fuel prices. If I'm looking at a company that is a technology company, I might be looking at breakthrough technologies or any form of technological innovation. So essentially, it's effectively just trying to tell you what is driving the performance of the firm. And when we're doing any form of forecasting, we tend to be very selective in the number of items we forecast, and we tend to only do basically the few necessary items that we need, because we essentially want to forecast as few items as possible. The more items you forecast, the more assumptions you need to make, and the more assumptions you need to make, the more, the higher the probability that you might make a mistake somewhere. Again, as I mentioned for this week, is that generally speaking, sales is where we start. So the first step is to forecast sales, and everything else is more or less completely dependent upon sales. And again, before we kind of start to forecast sales, we can look at past performance behavior of firms in general to try to give us an indication of how various ratios or how various relationships hold over time. So probably the most important part of this week is really around mean reversion. And when we're looking at mean reversion, we talked about sales growth in the beginning. So the idea that sales growth mean reverts over time. So just because your company has a growth of 50% right now does not mean it's going to persist into the future. On average, high growing firms are going to have a decrease in their sales growth over time, and firms that have a very low or negative growth will increase over time. And again, the whole reason why this happens is because of competitive forces. So when I see a company doing really well and they're selling a product and they're selling, I guess, huge quantities, I'm just going to copy what they're doing. It's going to increase my sales growth, but because I'm essentially going into their market, it's going to decrease their sales growth. So essentially, all these competitive forces lead to the fact that sales growth revert back to the mean over time. So in our forecast, we generally try to kind of account for the fact that there will be reversion. So in the sense that if you had a firm that had high growth, you generally forecast lower growth over time, whereas if you have a firm that has negative growth, you tend to forecast an increase over time, because again, you assume that there will be competitive forces. We did also talk about the idea that technically return on equity in itself also reverts back to the mean, but not as drastically. And when we want to look at return on equity, we could look at the individual components and their mean reversion individually. So again, return on equity from a DuPont analysis perspective is your asset turnover, your net profit margin, and your leverage. And based on prior evidence, what we can say is that generally speaking, asset turnover and financial leverage are rather stable, whereas net profit margin is the one that reverts back to the mean the most. So again, when we wanted to, for example, comment on which firm is doing the best, when we have 3 different firms having the same return on equity, by knowing the fact that net profit margin tends to revert back to the mean, I can already comment on the fact that if a firm gets a high return on equity from a high profit margin, it's going to be more susceptible to competitive forces and essentially having a decrease in performance over time. But again, all of these things essentially give us clues about how we're going to be forecasting the firm's performance. Because again, if I know that net profit margins revert back to the mean, again, I'm going to have in my assumptions some form of reversion in their margins. Whereas for asset turnover and leverage, if I know that they're rather stable, it's fine if I basically use almost exactly the same number from year to year to year. So again, we talked about some of the steps in the forecasting process this week. So we started to talk about the idea that technically speaking, a firm's performance generally is impacted by macro, industry, and strategy. So essentially you have the economy, you have the industry effect, and you have the strategy effect. So what you essentially need to understand is how these various factors might improve or kind of decrease various aspects of your performance. So essentially, what will the competition be within the industry? What will the supplier kind of power that you have kind of impact your financial statements? For example, if you have high bargaining power, generally that means lower expenses. If you for some reason lose that bargaining power, it's going to lead to higher expenses because your suppliers can essentially charge you more money. But the idea here is essentially just try to understand what is causing the firm's performance. Because if you understand what is causing a firm's performance, and in step 2, you're trying to understand the relationship between these two, you could then try to predict them for the future. And again, for step 3, really what we really are doing primarily is to just look at sales growth, and then we have a bunch of different assumptions with how various things are related to sales. So if you remember from the workshop, we forecasted sales. Based on sales, we could then try to forecast things like gross profit based on the gross profit margin. Based on sales, we could then also try to forecast total assets. Based on sales, we could forecast all these other various items. So what that means is that if you get sales right, you get most of the other things right as well. Whereas if you get sales wrong, everything else also falls apart. Cool, that's kind of it for the review. Does anybody have any questions? No, easy, yes.
For the exam, do we need to write like full answer, like full sentences?
Yeah, so when you're answering, I don't care about grammar, I don't care about amazing structure, but like generally speaking, you do want to explain and you do want to justify. So most of it's, because it's not like a memorization exercise, it's really to show that you can understand the end basically when you're answering. So for example, if something asks you something about the steps and you just give me the bullet points, it doesn't tell me that you know anything, it just tells me that you memorized it. So explaining it, giving an example would at least tell me that you know a bit more. So try to have some explanations, justifications, and so forth. Yes?
To go over my questions, the theory part, are you able to upload like what the ideal answer was?
For the homework questions? So the solutions here are...
Oh, therefore, okay.
Yeah. Okay. So they're there already, yes. I don't have the solutions for the midterm because there's no solutions. What that also means is that there are answers that are more right than others, but there's many different ways that you can basically get 100%, or there's also many different ways you can get 0%. But basically, there's no model answer here. It's really about how you justify how you explain. So I have had answers which basically go against what I thought would be the easiest answer to do, which still got 100% because they justified their kind of contrarian position. All right? So just, you're here, you've kind of tried, so that's like good first step. And then, again, I would say slides, you've been to the lectures, that's good. Readings are really good. So again, if you want to get a distinction or above, generally say the readings is where you get the most kind of meat in terms of understanding all the various nuances. I know you guys hate the readings. That is fine. But that is basically where you're going to get more additional information about various issues. And again, when I talk about the readings, I don't mean that you should read the entire thing. What I would suggest instead is that if you, for example, see, let's see, what did we cover today? For example, so if we're looking at, for example, decomposition of return on equity, find where the reading talks about decomposing return on equity and read that section. That's a much more efficient way of doing it rather than reading the entire thing. So I would say go through the slides, see, okay, so do I truly understand this? Go to the readings and say, what does the reading say about this particular section? To understand whether you kind of could more or less understand a bit more about that. But you don't need to do all the readings because some of the readings are just not covered in the slides. All right? Done? I'll see you on Thursday. Be here at 11. Oh no, sorry. Yours is 3:05. And yes. Chill. So again, 3:05 it starts on the dot. If you're late, you miss out on your perusal time more or less. All right? Cool. I'll see you on Thursday.